Hey, good morning, Joseph. How are you?
Good. How are you? Thanks for having me.
I'm good, of course. Thank you. Thank you for being here. We this is another installment of the it's a webinar series that we've been doing with Robinson Lloyd Resiliency Group. We do financial education, social emotional coaching, etc. And we're very grateful that we have Joe McGrath from Gradfin out of Philadelphia. He's a student loan specialist. He has a presentation for everyone. So hopefully, he's going to answer a lot, if not all, of your questions. And we'll be posting this shortly. But I'm going to begin by just giving a little background information on the company, and then also a bio for Joe himself. Robinson Lloyd Resiliency Group. We have a Resilient Starts program. It's a school-based individual and group intervention for students that enhances social emotional skills, which increases their resiliency. We utilize a patented manualized social emotional coaching curriculum program with actionable lessons that transfers these skills to the participant. We also use wellness scores to capture data, and this is one of the differentiating factors that separates us from a lot of different counseling services. Now, Joseph himself, he presents to financial advisors from coast to coast about the value of meeting with a student loan consultant to help navigate the perfect repayment plan. In addition to his current role in sales and client management, he has additional experience in both the recruiting and nonprofit industries, varied experience. Joseph currently lives in Philadelphia and is a graduate of Temple University's Fox School of Business with a BBA in marketing. And this is Joe, and obviously his expertise will help, he'll speak for himself. And Joe, the floor is yours, sir.
Perfect. Thanks for seeing me up, Sean. Appreciate it. You can see my screen. I just shared everything.
Yep.
Right.
Everything's great.
Cool. So yeah, perfect. So thanks for introducing me today. And as Sean said, we're going to go through a little bit of background with regards to Gradfin, what we do, how we can help individuals with student loans, and kind of how we go above and beyond just your standard refinancing or financial planning that a lot of other companies would go into, and how we actually connect one-on-one with an individual to go through any and all options with regards to their student loans. And some of the things I'm going to hit on today are, why you should refinance, what refinancing looks like today, options beyond refinancing, and then some just general education about student loans that might bring you up to speed on and give you some talking points with regards to what's going on right now. So the first thing I wanted to do is to get everyone on the same page with regards to student loans. It's really important that when you're going into a conversation or you're starting to think about refinancing, or even just kind of peeling back the layers of what your current situation is with student loans, that you have an idea of what else is going on right now, not just hyper-focused into what your current situation is. So as you can see right here, 70% of the class of 2019 graduates have student loans. 45 million people currently hold student loans, and that amounts to about $1.6 trillion. And you see the upward trajectory from 600 billion in 2007. And every year, more and more individuals are going to school, and every year, more and more individuals are incurring more and more debt. Over 90% of borrowers do not know what the current interest rates are, and they're averaging about 6 to 12 different loans when they're coming out of undergrad. And that could be a mishmash of both federal and private loans. Average interest rates, you can see, hover around 6.25%. Parent Plus loans amount to about 200 billion. With 4.5 million Americans having Parent Plus loans. And if you know anything about Parent Plus loans, average interest rates for them are more or less highway robbery. It's not uncommon to see anywhere from 7.5% to even 12% sometimes on Parent Plus loans. So if you're in a situation where you have those, you definitely want to look into it. Average balances upon graduation: undergrads 38,000, lawyers 150,000, doctors 225,000, and dentists 275,000 and above. And for whatever reason, with dentists, even though that seems like an insane amount of debt as it is, dentists seem to want to only marry other dentists. So suddenly that household debt doubles, and it's absolutely insane. So what does all this borrowing at such a young age do to an individual? Well, it has an impact on the ability to save for the future. It impacts your financial wellness going forward for years into the future. It has an impact on home ownership. student borrowers are 10% less likely to purchase their first homes from the ages of 23 to 33. And this compounds and has an impact on saving for the future, where now retirement is brought into the picture, where 50% of student borrowers have less than $50,000 saved for retirement. So I'll kind of go through this, Sean. You pretty much covered this already, but who are we over here at Gradfin? Gradfin's a student loan company that provides a comprehensive solution to borrowers to help reduce their debt by refinancing and consolidating their student loans. We already covered who I am. I was a third full-time hire over here at Gradfin. I was brought on January 2018, and I've been able and lucky enough to stay with the company and watch it grow and watch the team build out to what it is today. So let's look a little bit more into Gradfin. So, like I said before, Gradfin is a financial wellness program that's revolutionizing the way financial advisors or individuals or companies can help their clients or their employees or just individuals as a whole address their student loan debt. We're here to provide a comprehensive solution to help borrowers reduce their debt by refinancing and consolidating their student loans. And we're located pretty much right across the country. The main business development office is here in Philadelphia. I know main headquarters, stuff like that aren't really a thing anymore with everyone working from home. I'm lucky enough to only live a few blocks away from the office, so I'm still able to come in here and have some semblance of normalcy. But mainly we're located here in Philadelphia. We have an office in Washington, D.C., where the majority of our consultation experts are and refinance located. Our CEO and CFO are located out of Boston. And then Sarah, the fellow senior business development associate here, she's out in Los Angeles doing her thing down there representing Gradfin on the West Coast. We have a team of student loan experts who are here to analyze a borrower's new and existing loans and provide options for both their federal and or private loans, and transparency is key. For advisors, borrowers, whoever you are coming into the picture, our goal here is to not leave anything in the weeds, to always have a conversation with an individual and give them a clear-cut plan as to what their options are. That means educating them on their current situation, providing them context as to why they should or why they shouldn't refinance, and then laying out the steps one by one on how they can achieve that process and actually get them into a better situation. So you're going to be there with us from the entire process, the initial consultation, up until the loan closing, if you choose to refinance, or if you choose to take part in our public service loan forgiveness membership program, which I'll get into in a moment. But long story short, at the end of the day, what we're trying to do is simplify the complexities of student loans through our one-on-one consultation and use our knowledge of repayment and refinancing options to really customize and get the most optimum plan in place for what you're trying to do with your student loans. So why Gradfin? Like I mentioned before, the one-on-one consultation that individuals can take with us is our bread and butter. It's what separates us from any other would-be competitors that are in the market today. It's because we're one of the only people that are actually connecting on the phone with individuals to go through their current situation and analyze their new and existing loans and provide options for either their federal or their private loans. Like I mentioned before, we're here to simplify the complexities of student loans through our one-on-one consultation and our knowledge of all those repayment options. How are we able to execute these refis? Well, we act as a broker. We have 11 different banks that we use, 11 different third-party lenders that we use to refinance an individual student loan. And it maximizes the chances for employees to be approved with a closing ratio of over 80% versus other lenders that are typically in the 20-30% range. If you were to go to one specific lender looking for a refinance, they only want the upper 30% of applicants to come to them. Whereas with us, we're matching an individual to the bank that's going to yield them the highest possible chance of approval at the lowest possible interest rate. And let's get into that a little bit. Interest rate competition gives individuals the peace of mind that they're getting the best possible rates.
Joseph, that 20 to 30% range you just mentioned, absolutely, would that be based on the perceived ability of the person to repay the loan?
It goes into a couple different things. The main key things that would approve someone for a refinancing are income, credit score, and debt to income ratio. Those are pretty much the key things. In terms of an income threshold, what makes someone refinanceable, it kind of goes back to that thing. You have to do your homework and look into which bank. A lot of big banks out there have a threshold of $25,000, $30,000, $35,000. And if you don't match that on one spectrum, they'll actually look to another. So it kind of is like a weighted situation where maybe if your income isn't so high, but you have a pretty good credit score, they'll take that into consideration. And then if your debt to income ratio, is above that 40% range or something like that, they have a little bit more leniency. It really depends. A lot of people assume they can just go to one of the big banks and that would be their best chance of refinancing. When in actuality, some of these smaller internet banks have a lot more options with regards to who can get a refinance and why, because they understand there's a lot of individuals out there with varying degrees of income levels at different points in their career. It's not just those individuals who are making over 75,000 and their credit scores, 780 or something like that. Not saying that's a threshold for every single big bank that you're going to work with. We work with a lot of big banks ourselves, but it really kind of harkens back to why an individual should look into which bank I should refinance with and why. Cool. So to kind of piggyback on that, actually, it's a little bit, how can we help borrowers? How can we help individuals? Why take a call with us beyond the broker thing? Well, we're averaging about $38,000 saved over the life of any one refinance loan. If saving on student loans means a positive cash flow, who doesn't want a few extra bucks in their wallet per month? Who doesn't want some extra money to put down towards, a mortgage in the future or something like that, or just to have safe and for a rainy day fund? It allows the individual to start investing, purchase a home, purchase a car, go on vacation. You get it. Extra money means a lot more, a lot less stress in your life for the most part. We can refinance up to 100% of all federal and private loans. And we're here to handle the heavy lifting for student loans. There's over 180 different ways for an individual to pay off their federal loans. Right now, federal loans are in a little bit of an interesting spot. I actually have a slide on that. I think it's the next slide or the one after, addressing what's going on with federal loans right now. But assuming the program does wrap up in January, the CARES Act, that is, people are going to go back to paying on their federal loans as they were before the lockdown. So they really got to figure out what plan are they in. Is it the best one for them? Should they stay in it? Should they go to a separate one? Or should they refinance? And all of those things are stuff that we're going to advise on that consultation phone call. Student loans are complicated. We're here to make it simpler. We're there to provide a borrower with personalized options for their current situation, cater to what their current situation is with their income, credit score, debt to income ratio, et cetera. Federal programs. So right now, federal loans, like I mentioned, are kind of in an interesting spot. I'll get into it in a second, but assuming everything does go back to normal, what are some of the options? Well, first, public service loan forgiveness. I know, Sean, you and I spoke about this before, how we address people who are in this program. We have a membership program designed to keep people in compliance. I'll get into that in a second. And then income-driven repayment programs. There's multiple different income-driven repayment programs for individuals who have federal loans. Your income-based, income contingent, pay, repay, graduate, whatever the situation may be. We're there to advise on what the right one is, what the optimum one is for a borrower, so they don't need to, so they wouldn't need to refinance, and we can keep them in their federal loans, and we can just put them on a repayment plan that makes the most sense for them. And we plan to make it easier for federal student loan borrowers to pay back the loans if your debt is high compared to your income. So they have multiple different programs for people at any level there. So public service loan forgiveness. This program is available to individuals who are working in quote unquote public service, public health systems, public schools, 501c3s, nonprofits, everything like that. If you have this program available to you, you are probably already aware. But what is it at the end of the day? Well, it was rolled out in 2007 under the Bush administration, and it was a program designed to keep people in compliance with the Department of Education, where they pay on their loans on an income-based repayment for 10 years. And at the end of the 10 years, the rest of the balance is forgiven. An income-driven repayment or income-based repayment program is a way to pay off in your student loans that every month or every year, it recalculates what your current situation is and gives you a monthly payment that takes into consideration other debt you have. It's a really great program for individuals who are just coming out of school or people that want to be on public service loan forgiveness. It's a really affordable way to make payments on your loans that are best fit for you. But in the long scheme of things, if you are not in public service loan forgiveness, if you're just paying income-based repayment by itself, that's something you might want to think about refinancing. But if you're in public service loan forgiveness, you'll stay in it for the entirety of the 10 years. So what do we do with people who work in public service loan forgiveness? Well, in March of 2019, we rolled out this program because we saw the numbers that were written on the wall. 98% of people who stay within public service loan forgiveness and try to do it themselves are rejected for forgiveness at the end of the 10 years. So that means they went through 10 years of monthly payments on their student loans, 120 monthly payments, just to be told they did something wrong along the way. Why is that the case? Well, there's a multitude of different reasons. It all stems from a low level of understanding of the Department of Education's rules and compliances with that program. And that's not necessarily the fault of the borrower. There are multiple hoops you need to jump through in order to stay in compliance with this program. You need to recertify your income monthly. You need to allocate payments correctly. You need to make sure you're tracking qualified payments. You need to make sure you report something if you change your position, you go to a new hospital, you go to a new school, or you miss a payment you may not even be aware of, and that knocks you out of contention. There's multiple different ways. So what do we do to keep people in compliance with this program? Well, it is the only fee-based program that we have. It's the only time you'll ever be charged for anything. It's $250 per month. But basically what we do for $250 per month is we keep you in compliance with the Department of Education's law. So we are here to help borrowers stay compliant with public service loan forgiveness by enrolling their loans in the program, certifying their employment, annually certifying their income-based repayment plan, auditing their qualified payments, and just holding their hand from the beginning to the end of that program to make sure they've done everything correctly. We actually track all the payments internally, and the Department of Education says, well, you didn't do X, Y, Z correctly. We actually have the proof. We can say, well, we actually have the proof that they made this monthly payment, they did this, they did that, whatever the situation may be. What we're doing is keeping borrowers in compliance with that program. And with the suspension of federal loans right now, and I have a slide on it next that I'll kind of cover this in more detail, but if you are aware of the CARES Act and the fact that federal loans are suspended until the end of the year, the suspension of PSLF payments will still count as qualified payments under the legislation proposed in Congress. So that's just something to keep in mind. Again, if you're someone who's in these situations listening to this and you want to know a little bit more detail into what that means with regards to you, that's why we're chatting here today. We'll get you on a call to set up and go through everything. But like I mentioned before, an income-driven repayment plan is a plan that makes it easier for federal student loan borrowers to pay back loans if your debt is high compared to your income. And income-driven repayment plans are the only qualifying payment plans for public service loan forgiveness. So, the CARES Act, suspension of federal loans. I'm sure you've heard about this, especially if it being an election year. Student loans are a huge talking point. Back in March, I think it was around March 10th or March 13th, Congress announced they were going to suspend interest rates on federal student loans. About 2 days later, they backpedaled, said, okay, interest rates and monthly payments are suspended for federal loans for 6 months. It was actually supposed to have been wrapped up by this month. Beginning of September, they made an announcement. We're going to extend it out until the end of the year. What does that mean? Well, that means federal loans, if you have them, which the majority of individuals do, because the first thing you do when you take out student loans is fill out your FAFSA and max out on federal loans before you need to take any private out. But federal loans, you're not obligated to make any payments until at least the beginning of the new year. If you ask me, I think it's going to be extended in January again, just the way things are going, but that remains to be seen. So basically, if your loans are eligible, you would need a direct loan or a federally owned loan. Private loans or FFEL loans are not eligible. Easiest way to figure out if you're enrolled in this program, log into your loan provider and everything will be zero. Everything should have automated to zero back in March. It's probably the easiest way to do it. So how are we talking with individuals who have their federal loans frozen until the end of the year? Why would we want to talk to someone? Well, in actuality, while it may seem like, well, no, I don't have to make payments, I'm good to go. Well, now is actually one of the better times to look into your current situation because one, you're not under the gun. You're not obligated to make monthly payments as if you were back before March. And two, there's actually a lot of ways you can play around with federal loans right now. The fact that you don't have to make payments doesn't necessarily mean that you're kind of stuck in your current situation. The total cost of your loan doesn't change. You're effectively kicking the can down the road. You're still gonna have to pay back the entirety of your loan plus interest. But that's not necessarily a bad thing. How many million Americans in the last few months filed for unemployment? How many people lost their stream of income, or at least a large majority of it? If you are in a situation where you can no longer comfortably make payments on your student loans, take advantage of the program. There's no reason not to. Take a call with us. We can advise you on why you should or why you shouldn't, and go from there. If you have the means to continue making payments on your student loans, well, everything you pay right now goes directly to the principal. Not a cent of what you pay on your federal loans right now goes to the interest that you have accrued. So everything you pay, you can start hammering that monthly payment and actually start watching that principal balance tick down and down and down. Really a smart time to do that. And then refinance. Well, why would you want to refinance a federal loan that you're not obligated to make payments for until the end of the year? Not a lot of people would. You're 100% right. However, if you're in a situation where you're lucky enough to make a good amount of money and you know that income stream is going to change and you want to lock yourself into a really low refinance rate, I'll get actually into what the current rates are for refinancing in a second. But if you can lock yourself into a low rate right now and put you on a plan where you can pay off that loan in a few years shorter than you would before, we can help you with that as well. And then in January, if the program does wrap up, if rates are higher then, Well, great. You struck while the iron was hot. If rates are lower, well, you can just refinance again. You can refinance your loans as many times as you like. You can only consolidate them once. So this is just something to get an idea of where interest rates are for refinancing right now. This isn't a guarantee by any means. Always depends on the borrower more so than what the current interest rate environment is. But it's a good jumping off point for your average borrower who may tick all the boxes that we're looking for. 20-year 3.9 to 5, a 15-year 3.75 to 4.75, 10-year 3.4 to 4.5, 7-year 3.1 to 4.2, and then a 5-year 2.7 to 4%. Again, depends on a number of different factors, but people always kind of like to see, what rates are right now and get an idea of why they should refinance. But this is the big thing that I want you to look at. This is what every individual who takes a call with us is going to see at the end of the consultation. They're going to be sent an email that contains this. This just gives a summary of what your call consisted of when you spoke to someone on the phone with us, and gives you our offer for what we think you're going to be able to get on a refinance if you go forward with one of our banks. What's really important to see here, the top kind of lays out the current situation that the individual has with regards to their student loans, and assuming they're $357,000, lucky this person, right? FICO 750, or sorry, they're making 170,000, but still. This individual, from a 15-year down to a 12-year, the far right at the bottom box there, you see how much they were going to be able to save over the life of that loan by refinancing. And that's the key number at the end of the day. If it's interest rate that we can get and how much they're going to save over the life of the loan. Those are the two main factors that you want to pay attention to when refinancing your student loans. So I know that was a lot of information to be thrown at you at once. If you have questions, Sean, I'm happy to answer them. Thank you again for having me come in today, though, and chat.
Wow. Yeah, that was a lot. All right. Well, what just popped into my head was could you describe a situation or a couple situations where you give people an idea of the advantages of refinancing versus the consolidation? Or would you refinance after consolidation, or is it refinancing individual loans? And what is the advantage of each one?
Yeah, that's a great question. So again, when you have to look at a situation with student loans, it's really important to realize that no one situation is unique. Everyone has their own portfolio of loans. Everyone is at their own situation financially. So with regards to consolidation versus refinancing, they're kind of one and the same, but they're also, you can do, consolidation doesn't necessarily mean you're going to refinance. You can actually consolidate all of your federal loans together within your current provider and get a one monthly payment, one interest rate across the board. With consolidation, though, you got to take into consideration that by combining all of those loans together, you may be combining some higher interest rate loans and some lower interest rate loans, and you may end up paying more over the life of the loans that you would have actually paid off in a shorter amount of time by just combining them. So when you got to take into consideration is, okay, can I stay in my current provider and just consolidate my loans so I just make it easier for myself? I only have one monthly payment, I'm good to go. Well, if you do that, like I mentioned, you may have to pay more over the life of the loan. If you look at it versus consolidation versus refinancing, you can kind of break up your current portfolio and only refinance those higher interest rate loans to a lower interest rate loan, and then consolidate your lower interest rates and keep them in the provider that you currently have. I know it's kind of like a muddied answer, but the idea is you got to look at am I going to put myself in a position where I'm going to pay more for certain loans over the life of the loan by bringing them all together, or should I separate them, refinance one, consolidate the others, and then maybe have two monthly payments? So it really depends on what you're looking to do. If you only have two student loans, for instance, if you're lucky enough to be in that situation and there are two interest rates that are relatively similar, well, yeah, you can definitely consolidate those and be put into a very similar situation. It's probably going to alleviate a little bit more stress. If you have all private loans, for instance, or a lot of your loans are private, average interest rates on private loans are typically around 6.5% to 7%. Those rates are definitely something we want to look at. So that's when you should look into refinancing. The interest rate is always key. So it really depends on the situation, but it just got to look at long-term planning, paying more over the life of the loan. What's the situation that's going to make me pay the least amount of money in the shortest amount of time and get these loans taken care of?
Sure. Okay. Well, how long does it take typically, or how many meetings for you to really come up with a plan for a client?
So the consultation, unless we do, usually if it's one-on-one, we're done in 30 minutes. Not even that, maybe 25, 30 minutes. That's typically how long it takes for one individual. Sometimes we do a call where it's a married couple, or maybe they have a couple different kids. Those situations, it may get stretched out to an hour. It just depends on how complex it is. But in terms of actually connecting with someone and giving them a game plan to refinance and actually getting them on that new program, the process takes about a month. We can get someone pre-approved for a refinance in that 30-minute time frame. If we talk to someone and we know right away, okay, we want to send them to this bank, they're going to get approved. We can send them to the bank, they get approved and good. The longest amount of time that it takes is actually on the bank side to do all the underwriting and get everything approved. So it's typically one payment cycle when they go from their previous payment and interest rate to their new refinanced monthly payment.
All right. And I know one thing that people that will watch this will want to ask, that's probably their first question is, what's the fee structure like? Because I know you mentioned the $250 a month for to facilitate the loan forgiveness program, but what would be like just an average fee structure for a consultation setup?
Yeah, I just realized I probably should have had that in my presentation. So we actually don't charge, we don't charge the borrower, we don't charge for these calls. We make our money through the banks that we work with. They pay us on a back-end spread if we're able to execute a refinancing on their student loans. Say we talk to someone who shouldn't refinance for whatever reason. Our idea is, we're still going to be working with a number of different individuals who come under your banner, right? So if we talk to say three to five people, and 2 or 3 of those people don't refinance, but those other 3 do, those extra 20-minute calls where we just advise people on what the best course of action is with regards to their federal loans or how to better pay off their loans doesn't involve refinancing, that's completely fine because it's just 40 minutes out of the day where we're still providing you and your team a service. And those other people are actually going to be the ones that get us the payoff from the bank. So it's no charge to an individual to take a call with us.
Oh, wow.
Yeah.
Yeah, that is good information. Yeah, I think
that should have been yeah.
No, that's fine. I'm just glad we got to that. But yeah, that's something that I'm sure everyone would be and that would probably motivate more people to actually be more interested to figure out what you're doing and to actually see out some help. But
Definitely.
wow. And that presentation was so detailed. And one of the great things about it is that this is on video. They can pause it and read it. They can call you up and have a frame of reference to ask questions. So and it was very thorough, Joseph, and thank you very much. Hello, you hear me? Hello?
I think I lost you there.
Oh, okay. Oh, well, basically what I was saying is that they can pause.
Can you hear me? I'm back.
I hear you. They can pause. Okay, the information is very detailed. It's a very dense presentation. So when and if they do decide to call, particularly given that fee structure, it's awesome. I mean, that also motivates you guys to do the best job that you can because you're not even working on a commission traditionally in the traditional sense. But thank you again, Joseph, for that presentation, and that was awesome.
Yeah, for sure.
All right. Okay. All right. Thank you. We'll sign off.